Good evening and welcome to iBanker News Tonight, part 2 on this very early Friday, February 6, 2026. Tonight we explore Wall Street is quietly preparing for collapse. They're not panicking, they're preparing leverage, delivery, risk, and why insiders aren't surprised. Buckle up, this one's going to be bumpy. The math is in. The risk tolerances are ugly. They're not just buying bunkers anymore. They're buying metal, and not the decorative kind you put in a Tesla showroom. Gold, silver, physical only, bars, allocated, segregated, serialized, audited by guys with clipboards and trust issues. The kind you can actually pick up, assuming it's still there when you ask for it. And here's where it gets interesting. Let's start with silver. On paper, silver is boring, a poor man's gold. An industrial metal, volatile, sure, but manageable. And that's the story you're told. But meanwhile, the people who actually understand how the plumbing works are staring at the silver market like Brad Pitt in The Big Short staring at the subprime loan tapes, quietly horrified, slightly nauseous, and absolutely not dancing. Let's talk numbers. Wall Street loves numbers. We love numbers. But so do doom preppers. COMEX silver trades at leverage ratios that would get a regional bank shut down by lunch. Depending on the month, you're looking at anywhere from 150 to 1 to 400 to 1 paper to physical, meaning that for every real ounce that could theoretically be delivered, there are hundreds of claims outstanding, perfectly fine, totally normal, nothing to see here, until somebody actually asks for delivery. And suddenly, the language changes. Cash settlement encouraged, force majeure, exchange for physical, EFPs, roll incentives, anything except, metal. Now layer in what insiders have been muttering about March COMEX for a while now. March is a big delivery month. Historically heavy open interest. Historically heavy stress. And this time, inventories are thinner, eligible metals keep quietly migrating out of registered status, and the spreads are behaving weirdly. Backwardation where it shouldn't exist, lease rates spiking, physical premiums doing their own thing entirely disconnected from future prices. Coin shops charging 20, 30% over spot, while CNBC tells you silver is down on the day. Down according to whom? Which brings us to the whispered about January 30th silver plunge and the one from earlier today on Thursday, February 5. The kind of thing that Wall Street pretends doesn't exist until after it happens and then pretends it was obvious all along. A sudden violent sell-off, enormous volume, algorithmic, surgical, prices discovered by sledgehammer, not driven by fundamentals, not driven by demand, driven by positioning. Margin clerks doing cardio. Weak hands vaporized. Headline screaming, silver collapses, while physical flows don't. And that's the tell. Because when price collapses but delivery risk increases, you're no longer in a market, you're in a confidence exercise. Futures as a narrative control. Spot as a suggestion. This is where the Brad Pitt character comes back in. The guy who understands that when the trade works, it doesn't feel like winning. It feels like watching a structural failure in slow motion. He knows that the math works right up until it doesn't. And when it doesn't, everyone suddenly discovers they were leveraged to the same assumption. Wall Street doom preppers see silver not as an investment, but as a diagnostic, a stress test for trust. If COMEX can manage March deliveries, fine. System holds. If it can't, if settlement quietly goes cash heavy, if rules get temporarily adjusted, if delivery is technically honored but practically discouraged, then something breaks, not all at once, but enough. Because the silver market is small, tiny, ridiculously small relative to the global capital flows, which is exactly why it matters. It's the canary. It's where leverage gets sloppy because nobody thinks it matters. Until it does. And that's why hedge fund managers with bunkers care about silver delivery ratios. That's why when they read warehouse reports like scripture, That's why they don't trust spot prices, but obsess over who actually has title to what. They know this isn't about silver. It's about whether financial assets are claims on reality or just very sophisticated vibes. So when you see Wall Street insiders quietly prepping for doom, don't assume they're crazy. Assume they've run the scenarios. Assume they've stress tested the system. Assume they've noticed that the same people assuring you that everything is stable are also quietly making their own claims can be converted into something you can hold. And if you're wondering whether they'll warn you before it matters, look at Brad Pitt's character again. He warned them. They just weren't supposed to dance. Thank you for watching all the way to the end. Join us tomorrow evening, where we discuss what our grandparents knew about money, and we may relearn really soon. Please subscribe, comment, share, if we have earned it, to the sworn enemy of lying, hypocrisy, Wall Street tyranny, and anything else directing you towards the wrong side of the trade. Until then, as always, build that stack.